Welcome to another entry in the Dividend Kings YouTube series. Today we're going to talk about a company that has experienced some really incredible growth. Now this growth has come both in terms of share price appreciation as well as dividend growth. And as you'll see later on in the video, these two things put together can actually amount to somewhere around a 12% annual return. And I think that's being a little bit conservative. Now the company in question, as I'm sure you've seen from the title of the video, is Lowe's company. Ticker symbol LOW, and it is a home improvement company, but also, crucially, a dividend king, which is what this whole series is all about. If you're interested in learning what a dividend king actually is, it's just a company that has been increasing its dividends for over 50 years. Yes, that's half a century. I've been making videos like these every single week. Make sure to subscribe to my YouTube channel if you want to be the first to know when I publish a new Dividend Kings video, and also other personal finance and other investing videos. I'm going to put a link here to the Dividend Kings playlist. The previous video was on Altria. That was a really well received video, so make sure to check that one out. But without further ado, let's get started with Lowe's company. Let's get this video rolling. Hello guys, my name is Ricardo Torres. I am the founder of Escaping to Freedom, where I teach people how through dividend investing, they can actually get more freedom in their lives because of the passive income that those lovely dividends bring your way. Now, in this video, I'm actually really excited because this is a company that I have purchased recently. And I'll tell you more about that at the end of the video when I tell you what my personal view is on Lowe's company. Now, just like with my other detailed deep dive videos on dividend growth stocks, this is how I'm going to structure the video. First, I'm going to tell you what the company actually does. I think there's actually sometimes a slightly underrated element to investing. The business model should be simple, all right? So that's the first part. Then after that, we're going to discuss the past performance of the stock in terms of earnings per share and also in terms of dividends, because that's the juicy part to us dividend investors. Then I'm going to show you the highlights of the company's financials. I'm going to distill the real important numbers. I'm going to show you the good, the bad, right? Everything that you need to know to make an informed decision, and then decide whether you actually want to buy this stock or not. Then I'm going to go over the value and then the potential annual return that you could experience if you actually bought Lowe's at the time that I'm recording this. And then finally, the outlook, the challenges that both the industry as well as the stock could face in the future, as well as my personal opinion, in case you're interested in that at all. So buckle up, be ready for another deep dive dividend investing video. Let's get started with exactly what Lowe's does to make money. So Lowe's is a company that deals in home improvement, right? People want to get a new faucet or a new shower or new decking for the garden, they go to Lowe's. Now it's actually the second largest home improvement company in the United States, just behind Home Depot, right? That's another great dividend growth stock, but it's not a dividend king, and today's video is about Lowe's. They're actually a company that makes an awful lot of sales, $72 billion in sales in 2019, and they serve an incredible 18 million customers per week. Now, what's interesting about Lowe's is that during the pandemic, they didn't actually have to close their stores, which is something that a lot of companies were forced to do. But Lowe's was actually deemed an essential business, and therefore it didn't have to close their stores. So you know, if lockdown comes back again or the economy is really struggling, Lowe's should be okay. Plus, with more people staying at home, a lot of people have got into home improvement projects, doing up their garden, you know, fixing that light bulb that doesn't quite work. So Lowe's has been doing well because of this. So in simple terms, that is what Lowe's does to make money. They sell home improvement products to homeowners, to renters, and also contractors. If you live in the US and you want a new kitchen or whatever your project is, there's a high chance that you're going to go to Lowe's and they're going to make money for their investors. That is the premise of Lowe's. So now let's look at Lowe's past performance in terms of its stock price. So at the moment, Lowe's is trading for around $148. If we actually zoom out to the max that Google Finance will actually allow us, in the last 10 years, if we look at 2010, let's see if we can find July 2010. Okay, 30th of July 2010 to today, the stock has actually appreciated by 600%. So needless to say, Lowe's has done pretty good in terms of its stock price. But there's a reason behind that, right? Companies' stock prices don't just go up for no reason. Their earnings have to back that up. And if we look at Lowe's earnings during that same period from 2010 till today, the earnings have gone from $1.37 per share in 2010 all the way up to $5.58 per share in 2019, and that's actually kept increasing in the first couple of quarters of 2020. Now, what's impressive here is that the average growth rate, the compound annual growth rate, has been over 15% per year, hence the increase in stock price that you've actually seen. So yeah, in terms of earnings per share, Lowe's has done really, really well. And what's impressive is that it's not that up and down like with some of the companies. Some of the companies, they've got good earnings one year, then some bad earnings, right? There's a level of cyclicality there, but with Lowe's, it's been pretty good. It's been pretty consistently going up. So obviously they're doing something well. A company doesn't just increase its earnings without doing a couple of things pretty well. Now let's have a look at the dividend history. Now I've mentioned how Lowe's is a dividend king. That's the whole reason why I'm doing this video. But the number of years that Lowe's has been consistently increasing its dividends non-stop, right? Not a single cut, not a single freeze, currently sits at an impressive 57 years. It's been increasing its dividend since 1963, which is really impressive. But what's more impressive is the rate at which it's been increasing its dividend. Just have a look at this, right? From the year 2000, where it paid a dividend of $0.03 per share, it's grown that to $2.06 in 2019, and it's already even more in 2020, even though it's actually the 5th quarter that they've announced a dividend without increasing it. That's no reason to get worried, okay? It's doing this to be a little bit safe, a little bit on the safe side due to what's happening in the world. They don't really know how it's going to hit their business. But what I want you to focus on is the incredible rate of increase of their dividend, because it's actually one of the best that I have seen in my career as an investor. Now, the average compound annual growth rate by how much it increases dividend per year, averaged out over many years, currently sits at 19.4% per year over the last 10 years. Granted, those 10 years have been a time of, really strong economic growth for the United States. But if we zoom back a little bit more to 20 years, the growth is actually even better, 22% on average over 20 years. And just take a look at this, right? For the most part, the dividend increases have been really spectacular. Especially from 2010 onwards, look at 14%. It's either in the mid-10s or even the 20% kind of range, right? From 2013 on especially, it's been really, really good. And have a look at this, guys, because this is pretty crazy. From the year 2004 to the year 2008, look at this, 81%, 60%, 62%. Lowe's was just making it rain for investors. If you were an investor of Lowe's back then, your dividend payments would have basically tripled in a matter of years, at least in terms of Lowe's companies. Now, what's interesting about this is that when Lowe's increases its dividend by a small amount, it's still like 6 or 5% for that year, okay? So even if Lowe's goes through some tough times, I don't know what the future holds for Lowe's, but even if it did, even if it's got a few bad years, I would still expect those single-digit dividend increases if it doesn't keep increasing its dividend by as long as it has done over the last few years. Okay, now let's talk about the financials of the company. And the first thing that I want to focus on is actually related to the dividend. Lowe's payout ratio, okay? How safe is that dividend? How much of their earnings are they paying as a dividend? This is something that I really like to see in a company. A payout ratio of over 60 or 70%, it leaves me a little bit worried, in case it actually cannot meet its earnings and its earnings per share growth, or it goes through some tough times, it might not actually be able to cover that dividend, let alone keep increasing it. So that's why it's so important to invest in companies with low payout ratios. Now, in case of Lowe's, the payout ratio has consistently been below 40%. In fact, it's been around 30% consistently over the last few years, which is really great news for investors. That's a really, really low payout ratio, which actually frees up plenty of money for Lowe's to keep expanding, keep improving their business. It's a similar story if we look at the free cash flow payout ratio, because before we were using earnings per share. If we use free cash flow, which a lot of investors prefer to use, it's a very similar story. In fact, it's even better. It's been using even less free cash flow to pay its dividend. Okay, in 2020, it seems to have increased, but then again, 2020 is not over. If we ignore that, the free cash flow payout ratio hovers around 25%, something like that, which again is really good. Something else that's outstanding is that Lowe's has been consistently buying back their own shares, which as a shareholder means that your shares are worth more every year, right? Because that means that the profits of the company get divided by fewer shares. So check this out, right? From 2011, Lowe's had 1.4 billion shares outstanding, and as of 2020, it's only got 755 million. That's a reduction of 45%, which is really good. You don't see this very often. So that's always something that I like to see. A company that understands that, you know, when times are good, it should be buying back its own shares, just in case it actually has to issue new shares in the future when it needs a little bit more of a money injection into the business. Now, another good sign is that the revenue has been increasing. You know, I normally like to see the revenue increasing at least by a little bit, because, you know, even a company with a flat revenue can still increase its earnings per share in other ways, but increasing revenue is a sign of a good business. And in the case of Lowe's, it's gone up from $48 billion in 2011 to, well, let's take 2019 because 2020 is not over yet, $71 billion. That's an increase of around 48% overall, which is pretty good. It's not incredible, okay? It's no Tesla or Google or something, but it is good. It's definitely good enough for a company of this size and a company of this level of maturity. Now let's talk about the financials that I don't like as much. First of all, I don't love their operating margin. I just don't think it's high enough. It's been hovering around 6%, something like that. Actually, the average over the last 10 years is 7.4%, which doesn't quite meet my minimum requirement of 10% operating margin. Something else that I don't like at all actually is the level of debt that Lowe's has acquired over the last few years. The debt to equity ratio, it was hovering about 1, but it's been increasing consistently every year. And in 2020, it's gone through the roof. The amount of debt is definitely quite uncomfortable. I don't really like seeing that much debt for a company. But then debt has two sides, okay? You can't just look at the debt to equity ratio and say, oh my God, that's too much debt. You have to look at how well a company can actually manage that debt. So a metric that I like to use is called the interest coverage ratio. It basically measures how many times it can cover the interest that it must pay in order to have that debt with the amount of money that it makes. It makes sense, right? A company that can actually cover the interest that it owes in order to have that debt is in good shape, all right? Now, the interest coverage ratio for Lowe's is pretty good. It's not incredible, but it's pretty good. It's definitely over my threshold of around 8 times interest coverage. In 2020, it seems like it's around a 10 coverage ratio, okay? So, you know, that's not too bad. I don't like the levels of debt. It's too much debt in my opinion, but at least it can actually meet its interest payments. Something else to consider is the credit rating of a company, because if a company's got a bad credit rating, it's going to have to pay a lot of interest on that debt, on that borrowed money. And in the case of Lowe's companies, it's actually got a BBB plus from Standard & Poor's. So it's not excellent, but it's definitely an investment grade. So that means that Lowe's can borrow money and have to pay a reasonable interest rate. So far, definitely more good signs than bad signs, okay? It really does look like a very solid company. I do like what I'm seeing, but now let's look at the valuation and also, more importantly, your expected returns if you decided to invest in Lowe's. All right, first of all, the elephant in the room. This is not a high yield stock. The dividend yield is only 1.5%. So that means that normally I wouldn't even consider this stock in terms of a dividend growth investor's perspective, right? Now, if we compare this to the average dividend yield that Lowe's has had over the last 5 years, that's been almost 2%, okay? If we go into more details, we can actually see that the current dividend yield is pretty much the lowest it's been in the last 5 years. It normally hovers around 2%. Every now and then you can get it for 2%, 2.3%. And then there was this really nice spike where it actually got over 3%, which is actually when I personally bought Lowe's companies. I got a dividend yield of 3.5%, so really nice, especially considering the dividend growth. But yeah, right now, not a great dividend yield. I wouldn't personally invest in Lowe's at such a low dividend yield. By the way, a disclaimer here, I am not a financial advisor, okay? This is not official investment advice. Always do your own due diligence. Don't just take my word for this. I'm just a guy on the internet, okay? You have to go out there and do your own research. Look at your individual financial situation, your financial goals, how much risk you actually want to take with your investments, and only then make a decision, okay? With that out of the way, let's now look at the price to earnings ratio, because it's actually a similar story to the yield. It's currently very high. It's around 25 PE, when the average has hovered around 19, right? If we look at more details, we can actually see that, it kind of fluctuates. It never really goes below 15 very often, except during the pandemic, it went below 15. It went to around 11 PE, but since then, the stock price has been pumped up, and it means that, the P ratio has gone through the roof, right? People seem to really be liking Lowe's at the moment, just like they seem to really be disliking Lowe's during that market crash that we experienced in March 2020. Now, I like to use the dividend discount model to value stocks and then use it in conjunction with a lot of different methods just to get a more realistic price target at which I consider to buy a stock, right? Using the dividend discount model with Lowe's, I'm just gonna put a 10% discount rate, and I'm gonna use an 8% dividend growth rate from now to infinity, even though Lowe's actually increases its dividend by way more than that. So this is being quite conservative. Now that gives me a fair price estimate of around $120, which by the way, it's really similar to using the P ratio difference as well as the yield difference. They're both around $112, actually exactly $112. And with the dividend discount model, it's around $115, $120, okay? That seems to be a fair price for Lowe's companies. Now, if we have a look at what Wall Street analysts reckon a fair price for Lowe's is, that's actually significantly higher to the other estimates. Analysts reckon that it's worth $144, but notice that analyst estimates have gone up dramatically over the last few months. You have to look at analyst estimates with a pinch of salt, okay? So overall, by all accounts, Lowe's is overvalued, all right? It's not super overvalued, but it's definitely overvalued. I would personally wait until the stock price goes down a little bit more. Perhaps there's a recession, okay, and the stock price really goes down. That is when I would buy Lowe's companies. And like I said, I bought in March. I got a 3.5 dividend yield, but I've not bought any more. I'm actually waiting to increase that position in Lowe's. Hopefully it goes even lower. Hopefully I can get an even higher dividend yield, because then when you couple the dividend yield that you get every year with the growth in earnings and therefore in the long run share price, that's a really nice return every year on average. Now let's look at that. Let's look at what expected return you could perhaps expect if you bought Lowe's at these levels. So on one hand, we've got that 1.5 dividend yield. That's nothing to go home about. It's nothing too crazy, but we have to couple that with what expected earnings per share or even dividend growth you can actually expect going forward. Now, nobody can predict the future. We can look at the past, but that's not necessarily what's going to happen in the future. That's why I like to see what analysts are reckoning is going to happen to the EPS of this company. So at the moment, analysts reckon that Lowe's is going to have a really good third quarter of 2020, and then Q4 of 2020 and going into 2021, it's actually going to do better than it did in 2019. We can see here that Lowe's tends to actually beat analyst expectations, at least in the last few quarters. It beat it by quite a lot in the second quarter of 2020. But if we look further in the future, analysts reckon that by 2023, the earnings per share will be at $8.33 per share. Now, if we actually do the calculation, that comes up to about 10.5% per year growth in EPS. in my opinion, and seeing the history that Lowe's has experienced, that's a little bit conservative. But if we add up the dividend yield of 1% plus 10.5% predicted earnings per share growth, that comes up to a really nice 12% per year rate of return. Now, it's also true that it's very likely that it's trading at too much of a P/E ratio. So that means that, when it goes back to the normal P/E ratio, it's probably not going to be at 12%. It's probably going to be closer to an 11%. But again, I think that's a little bit conservative in my opinion. I do expect Lowe's to keep track with the dividend increases. I mean, have a look at this, guys. I sound like a broken record, but like 20% dividend increases over the last 10 and 20 years. That is exceptional, and hopefully it carries on that way. The payout ratio is definitely low enough to allow Lowe's to keep on doing this. Okay, let's now talk about the outlook for the company. What happens in the future, and also what I personally think of the stock, because you already know that I own this amazing Dividend King, okay? I'm really excited about that growth and that 3.5% dividend yield that I'm personally getting. By the way, ignore that balloon there that I can see there in the background. It was my birthday recently, so there's balloons everywhere in the flat that I live in. But anyway, yeah, I really like this company, honestly. I really like it. I think the business model is solid. I think it's something that I don't really see going away anytime soon. It's not something that will be revolutionized by technology or something, okay? People will always have to live in flats or houses, okay? We're always gonna need a room and to paint walls and do the decking in our gardens. All of those things will always be there. Now, obviously, we don't know what's gonna happen with the pandemic and perhaps the recession that's gonna come because of the pandemic, okay? There's obviously some risk with this company. It is cyclical. In the past, during the financial crisis, people lost their jobs. Obviously, they had less disposable income. They spend way less money on home improvement. The same thing could happen now. Perhaps the recession over the next few years is even worse than the financial crisis. We don't really know enough. But I look at that payout ratio, I look at the history of this company, I look at the fact that it grows well, it's well managed, and I'm not really that worried, guys. I do see what they do as something that's always gonna be there. That, in the next 10 years, it's gonna keep making more money, all right? So yeah, I'm pretty comfortable with Lowe's company. Like I said, I got a really good entry point. If you can get an entry point like I did, hopefully there's an even better opportunity over the next few months or over the next couple of years, then yeah, perhaps I will definitely consider entering into a position in Lowe's companies, because this is a really good Dividend King. And in Dividend Kings, I know I did Altria, and Altria has a really high dividend growth rate as well as a really high dividend yield. But Altria and Lowe's are definitely outliers. You don't normally see this kind of EPS growth, but also dividend growth. So yeah, I really hope you've enjoyed this detailed analysis on Lowe's companies. Make sure to subscribe to my channel if you've enjoyed this video. Make sure to give it a like, because it really helps what I do, and it tells me that you guys enjoy videos like this, and it really helps my channel to grow, which is my main focus right now. I want to make my YouTube channel grow and reach as many people as possible so that we can all become better investors, all right? So guys, I really hope you've enjoyed the video. Like I said, subscribe, like it, share it, all those nice things. Let me know in the comments below what you think of Lowe's companies, all right? And also let me know if you stayed till the end of the video, because I'm looking at the time. Yeah, it's going to be a long video, just like with my other analysis videos. Yeah, guys, let me know in the comments what you think. Let me know what other Dividend Kings you would like me to analyze. And yeah, with that said, I will see you in the next video. Have a great day. See you later.